Global markets continued their recovery momentum, driven by renewed optimism over major trade agreements including US, Japan, and India-UK pacts, creating room for bullish investor sentiment. The S&P 500 and Nasdaq reached fresh record highs amid optimism toward upcoming US-Europe and US-South Korea trade talks. At the same time, Tesla shares declined significantly after profit warnings, while Alphabet rose on strong cloud and AI performance, indicating sector rotation in growth positioning. Despite cooling corporate earnings, disciplined investment strategies pushed equities forward. Underneath it all, institutional capital repositioned in response to global macro signals. Cryptocurrency markets experienced acute volatility as Bitcoin briefly slid below $116,000, triggering approximately $585 million in long liquidations. Ethereum also fell by roughly 1.3% to near $3,598, with its own long position liquidations totaling over $104 million, highlighting sensitivity to short-term macro shifts. Despite these shocks, on-chain data revealed sustained accumulation from institutional players as Bitcoin treasuries figures rose globally. More than 213,000 traders were liquidated across the crypto ecosystem, yet price staging suggested stabilization as confidence returned. Overall, crypto volume remained elevated, indicating persistent investor interest despite price swings. Trade developments played a central role. On July 24th, Japan finalized an agreement with the US halving auto tariffs from 25% to 15% and unlocking a $550 billion investment package, leading to a 3.5% rally in the Nikkei and broader Japanese equities. On the same day, India signed a comprehensive economic and trade agreement, CETA, with the UK, aiming to unlock a $23 billion trade corridor, a major boost for MSME exports and digital trade connectivity. These positive trade signals helped offset weaker corporate guidance across Europe and Asia. Global markets showed improved cross-regional coordination. Investor focus is now squarely on whether similar deals emerge with Europe and Korea. Asian equities delivered mixed performance. Japan and Australia posted meaningful gains, with investors optimistic about trade easing. However, Japanese markets also faced political uncertainty after Prime Minister Ishiba's coalition performance declined, raising questions over domestic economic policy. Seoul markets softened in response to export controls impacting the tech supply chain. China remained relatively steady, though export-oriented sectors experienced pressure. Across Asia, patterns reflect opportunistic positioning rather than broad sell-offs, highlighting regional differentiation within a global market context. European markets ended broadly flat to slightly lower as strong UK corporate earnings from companies like Lloyds Banking Group and Reckitt Benckiser were offset by downward outlook revisions at firms such as Puma and Valeo. The FTSE 100 temporarily hit record highs before profit warnings weighed on sentiment. The ECB held rates at 2%, maintaining a restrained tone while markets awaited further clarity on inflation trajectories. Meanwhile, UK consumer confidence responded mutedly to IMF warnings around rising fiscal pressures and retail growth, just below expectations. Investors reflected on the fine line between optimism and macro caution. US Treasury yields saw modest fluctuations as foreign inflows, especially from Japan, supported demand for US long-term bonds. The 20-year Treasury auction raised $13 billion, helping cap yield spikes near recent levels despite mild inflation concerns. The yield curve remained partially inverted between short and mid-term maturities, but credit spreads remained contained. Mortgage rates hovered around the mid-6% range, influencing housing affordability. These conditions suggest steady, disciplined bond demand underpinning broader market liquidity. Corporate earnings narratives remain uneven. Tesla suffered a sharp drop after management warned of difficult quarters ahead, while Alphabet posted strong results, especially in cloud and AI platforms. Other companies, including IBM, Honeywell, United Health, and American Airlines, reported significant profit adjustments, contributing to selective weakness across sectors. European firms facing energy cost pressures and tariff headwinds also revised forecasts downward. This divergence in earnings performance underscores the necessity for tactical sector rotation. Investors are favoring resilient earnings profiles over broad speculative allocation. U.S. macro data remained muted as retail sales rose modestly, but consumer sentiment dipped in anticipation of tighter fiscal policy. NatWest delivered robust Q2 profits and unveiled a significant share buyback, while IMF forecasts signaled tighter UK fiscal constraints amid slowing retail growth. U.S. consumer dynamics showed a modest rebound in June retail spending, but mixed inflation signals. Employment metrics remained stable, though wage growth showed signs of deceleration. These domestic fundamentals support cautious optimism amid global uncertainty. Regulatory clarity continued to benefit the digital asset ecosystem. Recent U.S. legislation and regulatory frameworks, including stablecoin and crypto market structure bills, gained traction, reinforcing investor confidence in token adoption. Public entity participation surged, with over 278 organizations currently holding Bitcoin, up from just 124 weeks ago, reflecting structural accumulation trends. Regulatory stability is accelerating corporate treasury adoption of digital assets rather than fueling short-term speculation. The stablecoin bill and Senate market structure proposals offer long-term credibility to the asset class. That deepening legitimacy supports crypto resilience even during price volatility. Market liquidity conditions remained robust despite volatility. Both VIX and MOVE indices remained relatively quiet, even as margin debt topped $1 trillion, signaling elevated leverage and potential risk. ETF flows remained positive across thematic sectors, including AI, crypto-linked funds, and managed futures, supporting structural growth trends. Fixed income markets demonstrated calm after reopening trading range except in segments exposed to trade-related policy shifts. Liquidity resilience combined with targeted flows suggests rational repositioning, not emotional dislocation. Investors are navigating with focus on allocation efficiency rather than chasing short-term moves. AI and tech earnings continue to dominate investor interest, with forward guidance from firms such as Alphabet, Microsoft, Meta, and Amazon crucial for forecasting longer-term market direction. AI-related enterprises delivered outsized strength, offsetting weakness in legacy tech sectors. The tech-led soft landing narrative persists as investors expect continued innovation funding. Investor preference shifts towards scalable, recurring revenue business models. Future earnings from Magnificent Seven names will likely shape near-term market momentum and sentiment. The global currency outlook reflected diverging central bank themes. The dollar strengthened amid safe haven flows, particularly versus the yen, which appreciated in reaction to domestic yield spikes. The euro weakened slightly amid ECB caution around inflation and trade uncertainty. Emerging market currencies fluctuated gently alongside capital flows tied to equity performance and commodity trends. Cross-currency stability suggests balanced capital allocation rather than panic. FX markets remain sensitive to macro shifts without dramatic disruption. Commodities showed differentiated movement. Gold rose modestly on safe haven bids, while oil prices corrected slightly amid demand concerns. Industrial metal prices moderated as Asian manufacturing data softened. However, selective optimism tied to trade agreements supported sector-specific rallies in copper and nickel ETFs. Commodity-linked equities responded positively where global trade flows seemed intact. Overall, commodity markets are reflecting strategic hedging rather than speculative excess, aligned with disciplined repositioning. Emerging markets delivered a variegated picture. China's Q2 GDP growth around 5.2% helped maintain investor interest, while India's MSMEs gained momentum following CETA trade deal approval. Southeast Asian markets reacted positively to improved export optimism despite local policy uncertainty. Japan's markets rallied, initially following trade news, but saw reduced momentum amid political transition risk. Across EM economies, allocation remains selective based on macro stability and growth outlook. Retail investor behavior showed renewed enthusiasm for meme stock activity amid broader equity gains, though institutional caution prevailed. Kohl's shares surged intraday on short squeeze dynamics, highlighting episodic retail froth amid calm macro conditions. Nonetheless, overall capital flows favored ETFs and large-cap stability over retail speculative names. This bifurcated sentiment environment displays maturation in market psychology, where emotional trading exists alongside disciplined portfolio structuring. Investors remain divided between opportunistic bursts and steady momentum plays. Venture capital activity remains conservative in response to macro uncertainty and rising rates, with biotech, fintech, and AI startups experiencing tighter funding conditions. Deal sizes and valuations have contracted modestly as investors prioritize proven revenue models and efficient capital use. Funding rounds now emphasize sustainable growth paths over aggressive scale metrics. Entrepreneurs and investors continue negotiating paths toward liquidity while preserving optionality. The VC landscape reflects recalibration rather than rebound exuberance. Real estate data indicated further moderation in housing demand trends. Lower housing starts, slower mortgage application rates, and affordability pressures persisted in key US and European markets. Yet regional inventory remains constrained in select urban areas, maintaining pricing support for some residential segments. Builders adopted cautious project pacing in response to rising financing costs. REIT performance diverged based on property type and geographic exposure. Overall real estate adjustment appears orderly and reflective of strategic adaptation. Credit markets remained stable, with corporate issuance continuing and spreads holding within recent historical ranges. No significant spike in CDS or high-yield default risk emerged despite heightened macro noise. Investors remained confident in credit provision, supporting liquidity across the fixed income curve. Corporate debt absorption remained consistent, indicating resilient demand from both institutional and sovereign entities. Credit market stability reinforces broader market composure. Sentiment indicators revealed cautious optimism. Technical support zones held firmly near Bitcoin 115,000 and S&P 506,300 levels. Volatility remained elevated, but managed by hedging and structured positioning. Investor maturity in managing risk was evident through increased options usage and protective strategies. The market narrative shifted from fear-driven aversion towards selective engagement. Emerging patterns suggest that volatility now fosters opportunity rather than uncertainty. In closing, today's $140 billion global asset rotation embodies strategic repositioning driven by trade policy progress, regulatory clarity in crypto, and differentiated corporate performance. Institutional capital flowed selectively into equities, commodities, and digital assets, favoring quality and growth aligned with policy developments. With Fed and ECB decisions looming alongside major tech earnings, disciplined investors have opportunity to capitalize on structure over speculation. Volatility signals calibration, not chaos. Stay agile and ready to act.